Hello and welcome to Business 7. Join us as we discuss economic matters, including economic growth forecast in Namibia, oil and gas exploration offshore the country, as well as the investment landscape in Namibia. We'll also take a look at tax matters in the country. Stay tuned.
Let me show you something. Don't worry. Next time, I check nice.
Thanks, but it's okay. FNB Insurance checks nicer.
At FNB Insurance, we provide cover for all your valuables, from your phone to your laptop to your car. FNB Insurance. You value it, we cover it. T's and C's apply.
Let's start by taking a look at the main business stories in Africa over the past week. This compilation was supplied by Reuters.
Here is what's been making the business headlines in sub-Saharan Africa this week. The World Bank said on Wednesday that it was alarmed by efforts to overthrow the democratically elected government in Niger and suspended disbursement in the African country until further notice. Niger has one of the largest World Bank portfolios in Africa, amounting to $4.5 billion covering the country's priority sectors. And it has also received $600 million in direct budget support from the bank between 2022 and 2023. Senegalese authorities blocked access to the social media app TikTok on Wednesday, after they dissolved the main opposition party and detained its leader, Ousmane Sonko. Power struggles have led to violent demonstrations and have damaged Senegal's reputation as the most stable democracy in West Africa. Nigeria is turning to gas as an alternative fuel after it scrapped a popular but costly subsidy on petrol. State oil firm NNPC said late on Thursday that it had partnered with Nipco Gas to speed up the adoption of compressed natural gas for buses, cars and tricycles to lower transportation costs. Britain said on Thursday that it had agreed deals with Zambia on clean energy and critical minerals. British Foreign Minister James Cleverly has used the trip to seek to enhance Britain's sway in Africa, welcoming regional talks on the Niger crisis and announcing support for Nigeria's agriculture sector. And finally, business is booming for Zimbabwean tailors who are cashing in on political party apparel demand ahead of the presidential and parliamentary elections due on August 23rd. A dozen candidates are vying to be the country's next president, but the main contest is between incumbent ZANU-PF leader Emmerson Mnangagwa and Nelson Chamisa of the New Citizens Coalition for Change.
Earlier this week, Ceres released their update on their economic outlook for Namibia. We are joined by Ceres's head of research, the economist Robert McGregor. Welcome to Robert McGregor. He is the chief of research at Ceres, an independent economist. Thank you for joining us in the studio once again.
Thanks for having me again.
Robert, Ceres yesterday released their economic outlook update. In general terms, what are you witnessing in the economy at the moment?
We've seen quite an incredible uptick in sentiment over the past 12 to 18 months, and we've definitely started to see this filtering through into the economy. We do expect growth to be a little bit slower this year than last year. So last year we have, according to the Statistics Agency, growth of around 4.5%. We're expecting growth of around 3.8% this year. This is an upward revision from our previous 3.5%, and I think a surprise to many, a bit more optimistic than most of the other forecasts out there at this stage. We are seeing some continued output growth in mining, which is obviously helping. I think in diamonds definitely a lot slower this year than what we saw last year. But also we are seeing some improvements, especially on uranium. We're quite bullish over the long term. Prices are very healthy, and that's encouraging a lot more activity, not just this year, but we think over the medium term. Additionally, in other parts of the economy, we're starting to see a bit more of an uptick as well. We think in some sectors of manufacturing, we'll start to see a little bit more growth coming through, but more of that from next year onwards. Similarly, in the construction side, I think this year will still be quite a poor year, but from next year onwards, we're expected to see a bit of an uptick, particularly given how low the base is. However, in the services sector, the tertiary industries, we are also starting to see strong activity. Tourism is obviously still bustling. We're seeing a lot of activity there. The arrivals numbers are looking very, very good compared to pre-COVID, especially 2018. 2019 was an exceptional year, and so it's still a tough year to beat. And then elsewhere, we're seeing a lot of good news. In wholesale and retail trade, the weak consumer is filtering through, and that is a concern for us. But, we are hearing some good stories here and there. Then on the transport and storage side, things are looking incredibly encouraging. Namport is doing quite well. They've had strong volume and revenue growth over the past year. We're expecting that to continue. There's obviously a lot of domestic activity contributing to that, but also there's a lot of activity in our neighbors that are helping. So mines popping up in Zambia and Botswana, and they're looking to use the Port of Walvis Bay as opposed to ports in South Africa, which is a huge opportunity for us. And then also the fiscal outlook is much improved compared to where it was just a year ago. And so we think that with the continued improving outlook there, then we should see a little bit more restraint on that sort of fiscal consolidation or pro-growth fiscal consolidation coming through.
You mentioned just now that obviously the figures are coming off a low base. Also, in terms of what we've witnessed since about 2016 and COVID, the forecast levels of growth, are those good enough to say that the economy is sufficiently growing?
To be quite honest, I mean, we typically need growth in the range of 4.5% or higher to actually have net job creation in the economy. And so we're still not quite there yet. We do expect to enter that range of growth after next year. But what's good to see is that we are having organic growth. So we are seeing growth above pre-COVID levels now, and growth above 2018 levels, which is when the economy peaked in real GDP terms. So we are starting to get in the right direction. Obviously, we need to still just make sure that we provide the correct policy to really capitalize on that.
We continue our discussion with economist Robert McGregor of Ceres, this time looking specifically at oil and gas as well as investment policy in Namibia.
The big buzzword, of course, remains oil and gas. What is your take on the situation currently?
Yes, so I mean, obviously, I think the activities around oil and gas in Namibia at the moment have been a big driver of the improvement in sentiment. But between mining and oil and gas, we've seen material net FDI inflows, and I think that's driving a lot of the increased activity and improved sentiment as well. We're seeing a lot of this money coming in, and it needs to go somewhere. It's helped also with, increased activity at the ports, Lüderitz and Walvis Bay. And, at the moment, we're still waiting to see what happens. From my understanding of the Petroleum Act, the operators have around 2 years from first discovery to complete their appraisal program. And so I wouldn't expect too much news before January next year, particularly given that the two that have made discoveries are also listed on stock exchanges elsewhere. So obviously they need to be very careful about the public information that they release and how it is released. But we are seeing a lot more encouraging activity. Activity in both harbour towns has picked up massively as a result. Similarly in Oranje-Munt, there's a lot of appraisal activity underway at the moment. And then also quite encouragingly, one of the neighbouring blocks operated by Gulf is looking to have some more activity pick up now. We believe Gulf will be starting a 2-well drilling program, exploration program in November this year, which will also contribute to a bit more activity and hopefully early next year, a bit more news around what's going on there.
You've spoken about FDI and the possibility of a lot of projects coming on stream. That brings us to policy. What is your take on the policy landscape in Namibia currently, and what needs to be done?
I mean, we've seen quite honestly record levels of net FDI flowing into the country, and that's very encouraging for us. It's also helped build up, I mean, a very, very strong international reserve position. In fact, the strongest we've seen on record. In policy, we do need to see a few things. I think firstly, there's a big opportunity to capitalize on what's happening in the region, particularly in South Africa. You know, there's a lot of, it's very often on the news, you see talk about South Africans emigrating. I think there's a huge opportunity for us to capitalize on that rather than them leaving the continent, making it easy for them to relocate to Namibia, bringing with them their skills, their capital, and job creation in our own economy. Obviously, that requires a lot of change in the ease of doing business, on the ability to invest, as well as on the immigration side of things. And it's really on the investment side where I think we're still lagging. There have recently been consultations on the investment promotion facilitation bill. And for us, that still remains a major concern. The sort of last draft that we've been working from is the one that was provided in late 2021. And there are still material concerns in the substance of that bill for us, particularly around the minister's ability to designate either entire sectors of the economy, so being able to decide who's allowed to operate in which sector. Is it government? Is it private sector? Is it Namibians? Is it non-Namibians? Does it have to be joint ventures? As well as government's ability or the minister's ability then to also reserve entire occupations in the economy. So effectively saying only Namibians are allowed to be employed in certain sectors. And quite frankly, this is not the right way to go. This is not the way to drive investment. Yes, we need certainty on the bill, but I think we need to focus on the good parts of the bill and get rid of these quite honestly anti-investment provisions in there. There are positive parts, you know, creating space for the NIPBD, sort of the national single window facility and similar. Those are things that we need, and that's a step in the right direction. But having such concentrated power over the economy is definitely something that will scare not just international investors, but domestic investors as well. It's a very real threat to anyone who wants to run a business or to expand an existing business. And just simply because you know, we might be told that the provisions might not be used in this way isn't sufficient. The wording is that it can be used in that way, and that's very much the concern for us.
Connection. It's in the human touch, the feeling of belonging. It inspires us and empowers us, creates clarity from complexity. It starts new conversations, unlocks the power of advice, and makes an impact on your life. At Alex Forbes, we pioneer insight to provide you with advice that connects your decisions of today to your impact tomorrow.
The Namibia Revenue Agency earlier this week held a stakeholder meeting with the creative industry in the country. The Commissioner of NAMRA, Sam Shivute, had these thoughts.
Now, maybe just to give you an overview, I mean, the total tax debt, we're talking about 73 billion. But out of that 73 billion, it's only 16 billion, which is capital, and I think 43 billion, it's penalties, and the rest is interest. But what one need to understand here, what I have noted, you will find some company or some individuals or company who have not been trading, and maybe they have not been filing. What you will find mostly there is just interest, because every day you have not filed, you get charged interest. And we are then saying that this amnesty is something that you have not seen before, because this is the first time that you have 100% interest and penalty written. In that case, we would want to encourage those who have those debt, come to the office. If you are not registered on the portal or in the ITAS, Integrated Tax Administration System, you get registered. You filed your return indicating that you did not trade and so on. Then it's cleared. You may not even need to pay. Some people may even need to pay 100 or 2. So the most important thing is consultation and engagement, and that's why we are here. I think the question of Mr. Vincent, I think it was addressed by Mr. Ndorokade, and I don't need to repeat that. And there was there was a concern raised about the creation of content. It goes to South Africa, and when it comes to South Africa, from South Africa, one again need to pay the VAT. Then you only have about 3 years. Basically, it's the fact that there is not much business sometime, and we must be able to create work for this sector. And also, of course, the question whether can the sector be exempted from tax for now until further notice. One need to understand the principle of taxation. Just because you are in business or you are an artist does not mean that you have to pay tax. You pay tax if you have made the income that meet that threshold. When you make more than 50,000 per annum, one then need to reflect and know that which you have made, and of course remember, you are still entitled to deduct your expenses. And when you deduct your expenses out of that, you have total revenue and you deduct expenses. It does not always mean that when you are in business, you just have to pay tax. You have your expenses to deduct. And of course, when you have then meet the threshold, then it's only when you are required to pay tax. I think it needs to be in someone's mind that sometime when you have made that profit that meet within the threshold, there is a portion that is not yours.
Basic food prices in Niamey, the capital of Niger, are soaring following a military takeover of the country. Reuters filed this report.
Niger's coup is hitting shoppers hard. Prices for basic goods are soaring. Ibu Kani, for one, is feeling it. He says the price for a sack of rice has gone up by more than a third, to around the equivalent of $25.
Frankly, I felt it in my pocket. And right now, where we are, we're all stocking up, I think. In a month's time, what's it going to be like? That's the question.
The toppling of President Mohamed Bazoum last month prompted ECOWAS, the Economic Community of West African States, to close borders and sever commercial ties with Niger. It's already one of the world's poorest nations. And some groups are urging the bloc to reconsider that move to avoid making hardship worse for Nigerians. The military junta leader has already floated the possibility of difficult weeks and months ahead. While panic buying doesn't seem to have kicked in, many are feeling the pinch. The cost of cooking oil is also up. Still, that doesn't necessarily add up to criticism of the coup. We must help those around us, and above all, help the new government, says this merchant. Even before the coup, more than 3 million of Niger's 26 million population were facing acute food shortages. Exacerbating the squeeze, some Western nations have also cut aid to Niger, a country where foreign assistance makes up 40% of its budget.
There is no end to the economic woes of Zimbabwe. Reuters investigated the issue.
Zimbabwean Regina Ruana joined a long queue at a bank in the capital, Harare, to withdraw her late husband's pension. But she was told banknotes have run out. Banknotes shortages are a symbol of the financial ruin that occurred during the decades-long rule of Robert Mugabe. President Emmerson Mnangagwa promised to tackle the country's economic woes, quote, head on. But the promised economic revival never came.
We used to have a strong currency and could afford a decent living, but life has become more difficult over the past 10 years.
Ruona's late husband's monthly pension of 24,000 Zimbabwe dollars, that's just over $5 is barely enough to buy about 4 pounds of sugar and half a gallon of cooking oil. Her predicament is shared by millions of Zimbabweans struggling with rising prices after the Zim dollar weakened 85% this year. At 101.3% year-on-year in July, Zimbabwe has one of the highest inflation rates in the world. Unemployment remains high, with only 30% of Zimbabweans holding formal jobs. During working hours, Harare's pool parlors and sports betting halls teemed with unemployed youth hoping for instant wins. Tendai Mubaiwa is a 33-year-old father of two.
There is nothing to do in the townships, so we play pool for a living. We play 3 tournaments every week, and winners can get up to $250, but you have to put in $5, sometimes 10, as joining fee. As you can see, most of the players are quite young.
Economists say Zimbabwe's dire economic conditions could galvanize voters against the ruling party in the election later this month. Political analysts have warned that Zimbabwe could head for another disputed vote, with the opposition being denied state media airtime and some of its rallies being blocked by the police. While Mnangagwa has played up progress in areas such as infrastructure development, Citizens Coalition for Change leader Nelson Chamisa, Mnangagwa's main challenger, has promised to grow Zimbabwe's economy. He also promised to fight corruption and end the country's isolation by the West over allegations of human rights abuses and electoral fraud. Critics say Chamisa has not explained how he would fund his election promises.
Every day, you make choices that make you legendary. Journey together with us on the path to securing your legacy as a member of the League of Legends. With the Select Platinum Bundle Fee Premium Bank offering, you will access tools that will enable you to thrive. If you earn 850,000 Namibian dollars per annum or more, you can apply for this offering today via bankvinted.com.na for only 447 Namibian dollars per month. Bank Vinted, a member of Capricorn Group.
That's it from the Business 7 studio for this week. Thank you for joining us. I'm looking forward to seeing you again next week. We're playing out with this report from the International Monetary Fund, and it takes a look at how high interest rates impact on emerging economies. Goodbye.
Interest rates in advanced economies have increased at the fastest pace in 20 years. And that has made some emerging markets economies especially vulnerable. Let's look at why. To start with, higher global interest rates increase borrowing costs, and many emerging markets rely on external financing for public spending. So, when interest rates go up, it becomes more expensive for countries to pay back their existing debt. It also becomes harder for countries to access new financing and could even increase the risk of default. Rising interest rates also make emerging markets more vulnerable to capital outflows. Since high interest rates in advanced economies mean higher returns there, investors typically move capital away from emerging markets, and that often entails buying advanced economies' currencies, which reduces demand for currencies in emerging markets, creating depreciation and ultimately inflation pressure. Now, in the face of these pressures, how can emerging markets respond? The standard short-term policy response is to increase domestic interest rates to incentivize investors to keep their money in emerging markets. But this isn't always optimal because it could lead to unnecessary economic contraction or even create financial stability risks, especially if the increase is rapid. That's why at the IMF, through our integrated policy framework, we advise countries on how to use a set of tools rather than just interest rates, depending on each country's economic characteristics and the type of external pressures it is facing. For example, in some emerging markets, foreign exchange markets are relatively shallow, so the exchange rate tends to be more sensitive to large transactions. If these countries experience sudden large capital outflows due to the loss of investor appetite, they can sell foreign exchange domestically to offset the negative impact on the exchange rate. And when a crisis is imminent, restricting capital outflows can be an option too. These policies, however, cannot substitute for a promising and stable growth model and prudent fiscal policies. So, given the recent rise in interest rates all over the world, what has been the effect on emerging markets? Countries with stronger growth prospects, lower inflation, larger reserves, have weathered the rapid rise in global interest rates relatively well. And because markets don't expect interest rates to rise much further, emerging economies are already becoming more attractive for international investors. At the end of the day, though, it will depend on actual monetary policy in advanced economies. And that's why clear guidance from their central bank is key to avoiding financial disruption to emerging markets.